where do you find safety? Joining us now for her take, Kathryn Rooney Vera, Chief Investment Strategist for Baltic Capital Markets. Kathryn, always good to see you. What do you do on a day like today?
I think you have to have already been positioned in value over growth, have a healthy cash position, definitely have some structured products that limits your downside, also limits your upside, but they're products that we've been touting to our clients for some time and able to execute. So certainly, you know, the cash and value, defensives, we're entering a recession. The Fed is hiking into a recessionary environment. So we do need to have positions that can historically outperform in very difficult times like this.
Kathryn, what would persuade you to use the cash? What I'm wondering is if we are reaching, how far away from a cathartic moment are we? How far away from this market finding a clearing price do you think we are?
Sure. If we do effectively, Guy, go into recession, we could see an additional 10% downside in equity markets. And I think that would be interesting to start to add positions and use that cash that we have accumulated on the sidelines. But I think there's more interest, for me at least, in the fixed income market. So we have the 10-year yields, 2-year yields flying, you know, the long end. Yields are becoming attractive. So if we see the 10-year, for example, go to 4, that's attractive. And I think the long end of the Treasury curve could serve as a nice hedge to risk assets at these levels. So I would start to accumulate. And I think that fixed income, as Guy, we move away from everyone talking about inflation, which has been, you know, stagflation is what happened this year. As we move away from talking about inflation, as inflation drops, which it inevitably will, and we talk about recession, the unemployment rate jumping, which is my perspective, I think the unemployment rate is inevitably going to jump. I think fixed income is going to catch a bid, and we need to go out the duration curve and start accumulating in the near term.
Hey, Kathryn, we just got a headline here in the Bloomberg. The yuan fell to the lowest level, the lowest closes to the weekend of the PBOC ban since 2015. Just the strong dollar, weak yuan, weak currency story. Is there a play in the FX market?
The FX market moves have been phenomenal today. Fascinating. The dollar has jumped significantly, and that's, of course, because of the difference in interest rate differentials, which I don't think is going to go away in the near term. So let's continue to bank on a few things, Alex, and that is a strong dollar for the near term. That is an inverted and increasingly more inverted yield curve, and I think you're going to get some attraction on the fixed income front. So those, I think, are the near term trends that are going to continue. The Fed is the place that, you know, to hide. I mean, the Fed is going to continue to hike rates, so Treasury, I think, are going to catch a bid. That's going to continue to keep pressure on the dollar and on treasuries, which I suspect we're going to see rates start to drop by the end of this year.
Kathryn, is this an equity market that you can ride out the downdraft? Or is this a market you should, rather than trying to ride out, bail out? Should you be getting out right now? Should you be selling?
Yeah, I think it's tough to liquidate positions right now because it's such a volatile environment, and you would be realizing some very hefty losses. So I'm not recommending our clients to liquidate their positions right now, but rather take advantage of any bear market rallies like we saw in the month of July to readjust portfolios. And I wouldn't be surprised, Guy, if we do get additional bear market rallies over the course of the next 6 to 12 months. So let's use those times to readjust, not in the peak of panic, which I think is what we are doing right now. So let's just add one more point, Guy, and I think that is when historically the equity market does catch a bid, and we do see a bit of a rally when the market has concluded that the Fed has reached its peak hikes. And I think we've gotten there. I don't think if they didn't hike 100 basis points this week, they're not going to. November, December could be 75 in November. My suspicion is that they do 50. I think the Fed is going to minimize or drop the cuts from here on out because inflation expectations are falling. Recession is a very imminent risk. And real inflation data is going to start to drop significantly.
Another headline, pound extending its declines, briefly trades below 110. I mean, really unbelievable moves. Hey, Kathryn, When does EM credit and corporate credit start to tank? Those things haven't fallen out of bed yet with everything else happening. Why and when does it happen?
Excellent point, Alex. And this is something I've actually been talking with our institutional clients about for some time. We have not seen that wave of defaults or delayed payments in the high yield market or in the EM spectrum, and that's coming. So I would be very cautious on both high yield and emerging market debt. If we're going to be investing in fixed income, I would be looking at investment grade. Yes, it yields less, but there is no alternative, is no longer an investing option. So I would say be very careful. That is coming. And when it comes, high yield and emerging markets are so inextricably correlated in terms of their price action that emerging markets going to take a hit. So I would be very careful with regard to risk assets, especially on the below investment grade front or emerging market front.
Kathryn, always great to catch up. Thank you for the analysis on what is an interesting day.